Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Wednesday, February 9th, 2022. And our top story today, defined contribution investor appetite for real estate in retirement plans. Joining me now to discuss this and a lot more, Aaron Green is with Ferguson Partners and Sarah Sheen is with PGIM Real Estate. Sarah is also the co-president of the Defined Contribution Real Estate Council. Ladies, great to see you. Thanks so much for joining us on the program this morning.
Good to be having us.
All right, Aaron, let's talk about this survey. It's a survey that the Defined Contribution Real Estate Council, NAREIM, and Ferguson Partners all coordinated on about real estate in the defined contribution industry. What can you tell us? What were some of the findings?
Yeah, so we fielded two distinct partnerships or surveys in partnership with DCREC and NAREIM, really each targeting a unique set of participants. So we had the manager survey, which was targeted to real estate investment managers actively managing defined contribution capital, really with the goal of gathering information on things like capital raising, how they're structuring their products, organizational metrics, and then general best practices in the space. And then separate and apart from that, we also fielded a survey targeted to defined contribution investors in order to understand their perspectives around private real estate, how they think about allocations, their desired product structure, and how they prefer to access real estate. And in both cases, really kind of the key takeaway from the survey was that you can really see the momentum in the space. So as an example, capital raising has really increased over the past several years. And for most of the managers in the survey, and as a result, so have their assets under management. And so when you look at aggregate AUM across the sample set, it's really increased by about 24% over the last 5 years. And I think what this really shows us is that there is greater demand for and broader adoption of private real estate among plan sponsors. And it's also reflective of the fact that you have new market entrants coming in and new introduction of new products by existing managers. So I think that this is certainly a trend we're going to see continue with broader plan adoption going forward. And likewise, more managers entering the space, really with the aim of getting exposure to this very significant investor channel.
Yeah, absolutely. And it sounds like there's a lot, as you said, a lot of momentum. Sarah, I want to come to you. You've been with the Defined Contribution Real Estate Council for a long time, and you've seen the progressive growth. What do you attribute this growth to?
Sure. Many of the listeners today may be surprised to learn that private real estate's been in DC plans for over 30 years. But the real evolution has occurred in the last 5 to 10 years as private real estate has shifted from a standalone option on the core menu to a sleeve within a professionally managed asset allocation solution, such as a target date fund. The industry has also come together during this time, and we've created greater standardization around how these investments can be incorporated into DC plans. And that includes areas such as daily valuation and liquidity management. So we often find the case for real estate is well understood. The real education comes around the mechanics of how we make the investments work in a daily valued environment. Another factor is the growing use of consultants and outsourced CIO services, which have certainly been supportive over the years of using diversifiers such as private real estate as they seek to help DC clients incorporate asset classes that have historically been offered in DB plans. Lastly, I'd say there's simply more choice. 10 years ago, there were only a few daily valued private real estate products available for the DC space. Today, there are 15 products for fiduciaries to choose from. So there's a true marketplace with differentiated choice.
And Sarah, just as a follow-up, are DC investors more sophisticated now? And I just get the sense with the consultants who are acting on their behalf in terms of being fiduciaries and the employers, there's a higher level of sophistication, but you tell me.
Yes, the survey did address and provide some insights in this area. So we found that 2/3 of respondents from the survey use packaged or off-the-shelf solutions, and these combine private real estate with a built-in liquidity sleeve, usually REITs, and 2/3 were using a single fund manager. That leaves a third that are utilizing custom solutions and a third that are using more than one manager. So the statistics around customization and multi-manager approaches do seem to point to increasing sophistication of the investor set. As you mentioned, it might also be indicative of consultant and OCIO involvement in structuring these solutions, which we're certainly seeing more of. And I'd say in addition to the survey results, anecdotally, we see broader thinking around the application of real estate in DC plans. So in addition to target date funds, investors are incorporating real estate into white label solutions. So think of a white labeled real asset fund, for example. We're also seeing emerging interest in other areas such as private real estate debt. So that all seems to point to increasing investor sophistication.
And Sarah, sorry, I'm not picking on you, but I have a follow-up question here. What about the shift to long-term participant outcomes? We hear about retirement income, and real estate has always been a diversifier, and it's really helped in that regard. Has that really helped bolster interest?
Certainly, we believe it has. The diversification that's gained from private real estate often comes in the form of downside protection. The stable income that you get from the rents generated by these products, it often smooths the ride for participants in DC plans. So when you take and analyze maximum downside scenarios, even using a modest allocation to private real estate can improve risk-adjusted returns and your downside capture ratios. And of course, in private real estate, there's also the opportunity for capital appreciation in the asset. So that combination of potential for upside capture and downside protection, we believe has the ability to positively impact long-term participant outcomes.
Yeah, and I have to ask you, Sarah, let's talk about inflationary pressure. We're all feeling it at the consumer level, higher gas prices, supply chain disruptions, driving the cost of things up. Has that really percolated more, help with percolating more interest in real estate?
Well, real estate does tend to weather inflationary periods well, given that commercial property rents are typically increasing as prices increase. And in fact, the survey, we did ask the top reasons for investing in real estate, and the top 3 reasons were diversification, risk-adjusted returns, and inflation hedging. Beyond the survey, investors are demonstrating increased appreciation for income that real estate can provide to a portfolio. So this is definitely an emerging trend we'll continue to monitor closely in future iterations of the survey.
Aaron, I don't want to leave you out of the discussion. I know you and Ferguson were the quarterbacks, and have to use that metaphor because we got the Super Bowl coming up this week. You were the quarterbacks in the survey. Let's talk about 2022. What's going to happen? What's coming up in terms of additional survey results? What are you expecting to gather this year?
Yeah, so the survey will be an annual effort, and we're really looking forward to this year's launch, which will come in spring 2022. And just like last year, we'll have 2 distinct surveys, one really targeted to managers and one targeted to investors. And the idea is really to continue to refine, make sure that we're on the cutting edge of kind of bringing this important information to the industry. And as the industry grows and the sector grows, to make sure that the survey itself also grows and reflects that in terms of broader participation, deeper and more robust questions, and really making sure that we're bringing those actionable insights to the industry.
Yeah, I think it's going to be interesting to see how interest continues to grow and change, and also the product innovation. Well, ladies, great to see you. Thanks so much. When we come back, we'll talk about the innovative product solutions happening in the direct real estate defined contribution marketplace. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings in retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. We're joined this morning by Yanni Ventnor of JP Morgan Asset Management and Michael O'Connor of Clarion Partners. Yanni is also a co-president of the Defined Contribution Real Estate Council. Yanni, Michael, great to see you. Thanks so much for joining us on the program this morning.
Hi, Jeff. Great to see you.
Yeah, great to talk to you guys. We had a great conversation with your peers, Aaron and Sarah, about the survey. And we're going to continue the conversation. Michael, we'll start with you. And let's talk a little bit about liquidity. This has been an issue, had been previously an issue in the past, but there's been a lot of innovative solutions to not only deal with other issues, but liquidity.
Well, Jeff, to really answer the question, I'd like to build on some themes that Sarah talked about. We really have to consider how is private real estate being pulled into the DC market environment. In most cases, and our survey findings have noted, they're being brought in through either a collective investment trust, a CIT, or an insurance company's separate account, and they're utilized in typically as an investment sleeve in a trustee-directed target date fund, a TDF, rather than necessarily being used on a fund lineup, participant-directed fund lineup. So as such, when you're used in a target date fund environment, the need for liquidity management to accommodate rebalancing and withdrawals is much lower. And that is also shown by the trends that we've noted over the last decade as these defined contribution real estate products were brought to the market. In the early days, we found that these products had a liquidity sleeve of 25%, but as time has gone on, plan sponsors have actually been looking for less liquidity. Many of the new strategies have an average of 15%, and some don't have any liquidity as the trustee is looking for greater allocation to the private real estate. It really comes down to having different solutions and different options, again, as Sarah pointed out, so that plan sponsors can choose what best fits their plan and fits their employee set.
Yeah, and you bring up a really great point. I'll come to you in a second, Yanni, but just to kind of follow up on that, when people buy target date funds within a retirement plan, it's usually buy and hold. You don't see a lot of people moving in and out of the target date fund traditionally, and so that means that, to your point about liquidity, there may be withdrawals, but there's not a lot of transfers in and out. I would think that that's certainly a positive when you can potentially reduce the liquidity buffer.
Exactly, Jeff. And what at the DCREC, we have monitored statistics that look back both at the GFC and the most recent pandemic period, and noted that there was very little, if any, outflow from target date funds. Obviously, some values went down, but in terms of net outflow of dollars, really wasn't the case because these target date funds are very large. They're getting about half of all new capital coming into the 401k space. So that payroll, just the crush of capital coming into them, is really reducing the need necessarily for liquidity management within these TDFs. It's really a rebalancing issue.
Well, thanks, Michael. And Yanni, I want to come to you because consultants, plan advisors really serve as co-fiduciaries in the defined contribution world, and they help drive a lot of innovation. Are they more amenable to the inclusion of direct real estate in defined contribution programs?
As Sarah noted earlier, the inclusion of private real estate in DC plans is not new. This market is established with a proven track record of successfully managing liquidity through multiple cycles. Now, over the last decade, consultants have been very strong supporters of promoting the benefits of including private real estate to their DC clients, both in an advisory and an OCIO capacity. But it's interesting to look at the structures through which investors access real estate, and that is supported by the data from our survey. Whereas 2/3 of these structures is essentially holding real estate through off-the-shelf solutions, and the remaining third is in custom solutions. Now, where we actually have seen an evolution is how consultants use real estate in their OCIO platforms. And this has been driven by growing sophistication and knowledge of the asset class, where it supported more innovative solutions that use multiple real estate products on these platforms. If we look at the state of the market today and the benefits that real estate offer, there's strong potential for growth in the OCIO and the advisory areas of the market over the next 5 years. So Mike, it would be interesting to hear your view of where you see growth in the consultant side over the next 5 years.
Well, one area that, I've been tracking as well as other members of the DCREC is as a result of the passage of the Secure Act, it really is enabling the rise of what's called PEPs, pooled employer plans. And OCIOs are in a perfect spot, if you will, to sponsor such PEP plans. And OCIOs in their by their nature, because of all the other mandates that they've had in the retirement space, are quite familiar with the benefits of private real estate. So I really believe that as these PEPs come to market, these pooled employer plans, that we'll find more private real estate allocation that mirrors some of the multi-asset strategies the OCIOs are already managing today on a discretionary basis.
Yeah, and just to follow up on that real quick, Mike, with the PEPs, you're delegating. If you're a small employer, you're part of a PEP, you're actually delegating some of the fiduciary responsibility. It's being professionally managed, and it would seem to me that if you're going to, just like a pension plan, right? In a pension plan, it's being professionally managed by staff and a CIO and consultants. It's very similar. You're relying on these experts, and they would include diversifiers like real estate.
Yeah, and migrating some of the very strategies that the professional managers, whether it's an OCIO or a professional manager for a DB plan, that are migrating these strategies, which have included for multiple decades private real estate, migrating them to the DC side. Again, I totally agree that we're gonna find more alternatives, including private real estate, private credit, private equity will find their way into DC plans when they have more professional management involved in the asset allocation decisions.
Yeah, I tend to agree. I think and there's no reason why a participant in a DC plan shouldn't have the same access to investments that you would find in a traditional DB plan. Yanni, last question for you, and I think you intimated, but I just want to make sure. The interest really is in target date funds and managed accounts. Did you ever see a time where a participant would have access to a direct real estate product, or is it really more focused in the target date managed account space, which, by the way, is truly evolving every day?
I think it's helpful to look back over the last decade where DC real estate growth has really followed the capital flows to professionally managed multi-asset solutions such as target date funds and white label funds. And that corresponds with the data in our survey, where target date funds and professionally managed solutions make up to 90% of the structures that offer real estate today. And if we look back in time, there's two things happened to create an environment that supported the inclusion of real estate in DC plans. The first was in 2006, the Pension Protection Act, that promoted the use of professionally managed plans. It allowed investors to include private real estate and manage that allocation in a multi-asset portfolio. The second thing that happened was that real estate managers recognized the value of blending private and public real estate in one solution. So investors could benefit and access the benefits of privates, but also get daily liquidity through the public REIT sleeve. Now, today, to get to your question, standalone solutions represent less than 10% of the structures offering real estate in the market. However, the DC market has shown increasing interest in accessing real estate in standalone and managed accounts since the correction in 2020, mostly as a component of a white label fund. And this has come from investors with existing exposure in target date funds, where they hold real estate, wanting to provide broader access of the asset class benefits to their participants. Now, I think it would be interesting to hear another view on that take. And Mike, I might ask you, in terms of structures, where do you see the growth and opportunities over the next 5 years?
Well, I think, Yanni, you hit the nail on the head. Is besides from target date funds, you noted the white label funds, which we are also seeing increasingly in the marketplace. Many plan sponsors have been thinking about how can they provide some access, not just through a target date fund, but also some access to real estate in what are these white label, more thematic options for the participant. What do I mean by that? Themes like real asset, or in this environment, which is very important, inflation hedging as a theme, also enhanced income. So these themes, which are otherwise called white labels, taking private real estate and also adding other funds that complement that theme, and then offer those to the participant on the lineup. And we're seeing more of those today being put on into the marketplace, generally by the larger plans, by the mega plans that are adding these things today.
But to your point earlier, Michael, we could see PEPs, which is a consolidation of different plans together, use these structures as well. So it seems like it's going to be a real interesting time, and it always is interesting in the retirement and defined contribution world. But target date funds, managed accounts, they're all evolving, and they're incorporating different asset classes. We're going to have to leave it there. Yanni, Michael, great to see you. Thanks so much for joining us, and we look forward to having you back on the program again very soon.
Great. Thanks for having us.
Thanks for having us.
And that wraps up this episode of BRNAM. Have a topic of interest, someone you think we should talk to? Well, drop us a line. And don't forget, for all the latest in lifestyle, wellness, finance, tech, so much more all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to see our latest content? Search our archives. Well, check out our website, www.broadcastretirementnetwork.com. And of course, our streaming partners like Amazon, Roku, Samsung, and over 100 more. We're back again tomorrow for another edition of BRNAM. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the first lifestyle and wellness network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts. so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.